Hello, curious minds, and welcome to another deep dive. Today, we're plunging into well, the really bustling world of internet retail. It's a sector that truly defines so much of how we live, work, and, you know, consume. We've got a fantastic stack of sources covering some of the sector's biggest names, and our mission for you today is to cut through all that data to find those real aha moments.
Indeed. And our listener wants to understand sort of a journalistic take on the sector performance, specifically for the top three internet retail stocks popping up on their screener: Amazon, Alibaba, and JD.com. So we'll be dissecting their fundamentals, technical analysis, price action, news, financials, valuation, the whole picture.
Right. And to make this really tangible, we're going to play with some paper money today. We'll imagine hypothetically investing, say, $10,000 into each of these three stocks exactly 1 year ago. That way, you can clearly see the estimated profits, or, well, losses, and how that actually shapes a theoretical portfolio.
Okay, but before we dive in, just a quick but really crucial reminder. This deep dive is strictly for informational and educational purposes only. We're using hypothetical scenarios, this paper money idea, just to explore stock performance. Nothing discussed here should be taken as investment advice. Always consult with a qualified financial professional before making any investment decisions.
Okay, perfect. Let's unpack this fascinating sector then. We'll kick things off with the undisputed titan, Amazon, ticker AMZN, US-based, internet retail powerhouse, and currently sporting just an enormous market cap of $2.43 trillion. From your perspective, what's the fundamental story really unfolding for Amazon right now?
Well, what's truly compelling about Amazon is how it combines that massive scale with the market's continued expectation for pretty significant growth. Its PE ratio, the price investors pay per dollar of earnings, is currently 34.82. The forward PE looking ahead is a bit lower at 30.1, which reflects that anticipated growth. But here's maybe the real insight. Its PEG ratio, that compares the PE to its expected earnings growth rate. It sits at 1.87. Now, for a company of Amazon's immense size, a PEG under 2 suggests the market still sees, well, a reasonable valuation relative to its expected growth, especially when we look at the projected EPS growth for next year, 13.7%, and that really strong past 5-year EPS growth of nearly 37%.
So even as this absolute behemoth, the market still views it as a growth story, not just, a mature value play. That's a powerful fundamental picture. How do the other financial health metrics look?
Yeah, absolutely. Its financial health looks pretty solid. The profit margin is 10.54%, which indicates, effective cost management. And its return on equity, the ROE, at 24.7%, and return on invested capital, ROIC, at 15.0% are particularly strong. ROE tells us how much profit it generates from shareholder equity, while ROIC looks at all capital. These numbers suggest Amazon is highly effective at turning capital into profit. Liquidity seems adequate. The current ratio is 1.02, quick ratio 0.81, meaning it can cover its short-term debts, and debt to equity is manageable at 0.46, so it's not overly reliant on debt.
That's a really good dive into the numbers. But for many listeners, the real question is, okay, how did that translate into actual returns, or in our case, hypothetical returns over the past year?
Great question. Amazon's performance over the past year delivered I'd say, solid 27.07% gain. So for our paper money scenario, that hypothetical $10,000 invested in AMZN 1 year ago when the price was around $179.54 would now be worth approximately $12,707.03. So that's an estimated paper profit of about $2,707.03.
A very respectable gain indeed. Now, looking at the technical side, Amazon's current price, these moving averages, what does this tell you? Short-term versus long-term. And how should we interpret that RSI figure, 49.35? Is that significant?
Okay, technically speaking, Amazon's current price, $228.15, is about 6% below its 52-week high. But it's also a healthy 41% above its 52-week low, showing significant recovery and strength. Its simple moving averages, the SMAs, which help show trends, they paint an interesting picture. The SMA 20, the 20-day average, is slightly negative, suggesting a very recent minor dip. But the SMA 50 and SMA 200, the 50-day and 200-day averages, are both positive, 0.61% and 6.63% respectively. This indicates a pretty robust long-term upward trend, despite maybe some short-term noise. That relative strength index, the RSI, at 49.35, well, it's right in the neutral zone. It's not signaling overbought, so potentially due for a pullback, nor oversold, suggesting a bounce, just neutral. And its beta is 1.30. That means Amazon tends to be about 30% more volatile than the overall market.
Right. So what does all that translate to in terms of potential buy or sell triggers for someone watching this?
Well, for a shorter-term trader, maybe a move back above that SMA 20 could signal renewed upward momentum, perhaps a buy signal. Conversely, a clear break below the SMA 50 might be a cautious sell trigger, to protect recent gains. But for longer-term investors, that strong SMA 200 performance is probably the more reassuring sign, pointing to a healthy overall upward path.
Okay, that gives it a really comprehensive look at Amazon. What about recent news? What's catching attention?
Yeah, recent news really highlights Amazon's strategic moves and, well, ongoing developments. Analyst recommendations average a strong 1.27 buy, with target price around $263.20, so sentiment is positive. Headlines point to substantial AI spending, which is a big theme everywhere. There's also a probe by the FTC over search ad practices, kind of recurring issue for big tech. And they're testing GM's electric delivery vans, part of their sustainability push. Also, some noise about Prime membership changes, maybe restricting sharing outside the main household. And interestingly, our sources flagged significant insider selling. Jeff Bezos sold over $5 billion worth back in July 2025, and other executives sold shares too. Now, this can sometimes raise eyebrows, but honestly, it often doesn't signal negative sentiment internally. It could just be diversification, tax planning, things like that.
Okay, fascinating stuff. Now let's shift our focus. We're heading east to China to explore Alibaba, ticker BBAYA.
Yeah.
It's often compared to Amazon, right?
Yeah.
But it definitely has its own unique market dynamics, and, well, recent performance trends have been quite different. What's the fundamental landscape look like there?
Alibaba presents a really fascinating contrast. It feels like a pivot point in its story, maybe. Market cap is $345 billion, so significant, but quite a bit smaller than Amazon. Its PE is 18.09, and the forward PE is 15.37. Now, these multiples are notably lower than Amazon's. That implies a different market perception. Maybe investors see more risk, or maybe they see potentially more room for significant growth if Alibaba hits its targets. What's really striking is the projected turnaround. Current year EPS shows a drop minus 14.79%, but analysts project a massive bounce back next year, EPS soaring by 28.85% and quarter-over-quarter EPS by incredible 82.10%. Plus, its past 5-year sales growth is still a solid 13.54%.
Wow, okay, those future EPS projections are certainly eye-catching. That really hints at a strong recovery potential. How does its financial health compare?
Alibaba actually boasts really strong liquidity. Both its current and quick ratios are 1.45. That means plenty of assets to cover short-term liabilities. And its debt to equity at 0.23 is remarkably low. That points to a very healthy balance sheet, minimal reliance on borrowing. Its profit margin is higher than Amazon's actually at 14.85%, and ROE is 15.22%. And unlike Amazon, Alibaba offers a dividend yield 0.65% with a pretty modest payout ratio. That might appeal to some income-focused investors.
And in our theoretical portfolio, Alibaba it stole the show, didn't it? That 86.51% gain, that's something to celebrate in our paper portfolio. Almost makes you wish it wasn't just paper money, right?
Absolutely. I mean, for a hypothetical $10,000 investment in Baba 1 year ago at around $83.13 per share, that investment would now be worth approximately $18,650.07. That's an estimated paper profit of about $8,650.07. Truly an impressive 86.51% gain.
Just incredible. But looking at its technical charts, what's driving that momentum? And maybe more importantly, are there any contrary signals for new money thinking about entering now after such a run-up?
Right, so Baba's current price, $155.06, is just barely like 1% off its 52-week high. And it's a remarkable 95% above its 52-week low. The SMAs 20, 50, and 200-day are all strongly positive, 17.79%, 26.28%, 36.36%. That indicates a really robust, sustained uptrend across all timeframes. However, the RSI at 72.73 is quite high. That signals it might be entering overbought territory. Now, that doesn't guarantee an immediate pullback, but it suggests the stock might be due for a breather, maybe a pause after climbing so fast. Its beta is very low, though, 0.13, suggesting significantly less volatility than the overall market. So, yeah, while the trend is strong, that high RSI could suggest caution for short-term entry, maybe wait for a slight pullback. A buy might be on a healthy dip. A sell trigger could be a significant break below the SMA 20 if you're trying to protect those very impressive recent gains.
Okay, that's a great interpretation. This raises a key question then. What exactly has fueled this truly remarkable performance from Alibaba this past year? What's the story?
Well, the news section really emphasizes Alibaba's significant investments and advancements in AI as a primary driver. That seems to be the key narrative. Reports mention building AI on their own in-house chips, a $3.2 billion bond offering specifically to fund cloud growth, and the unveiling of their new AI model, Qwen 3. Big AI pushes. We also see news about Alibaba's Ant Group unveiling its first humanoid robot. Interesting stuff, and its mapping service testing new features. These all signal aggressive innovation. Analyst recommendations average a 1.37 buy, with a target price near $164, reflecting positive sentiment around these developments, especially that deep commitment to AI.
Okay, really interesting dynamics there. Now, staying to line, let's explore JD.com, ticker JD, a different kind of e-commerce player, right? Known more for its strong logistics network. What's its fundamental story look like?
Yeah, JD.com offers yet another distinct valuation perspective. Market cap $45.5 billion, smaller than Alibaba, but still substantial. It has a remarkably low PE ratio, just 9.51, and an even lower forward PE of 9.09. Now, this suggests the market views it as potentially a significant value play, or maybe sees more underlying risk compared to its peers. It's a stark contrast. While current year EPS is down, minus 41%, projections for next year are strong, forecasting 44.27% growth, and sales growth over the past 5 years is a solid 14.04%.
A very different PE from both Amazon and Alibaba. That suggests, yeah, maybe an overlooked opportunity for some. How about its financial health?
JD.com shows decent liquidity, current ratio 1.22, quick ratio 0.88. Its debt-to-equity ratio is 0.44, indicating a pretty healthy leverage profile, similar to Amazon, actually. Profit margin is lower, 3.06%, but ROE is decent at 17.26%. What's particularly interesting here is the dividend. JD.com offers the highest dividend yield among our 3 stocks, 2.11%, with a payout ratio around 26%. That definitely makes it attractive to income-seeking investors looking within this growth sector.
Right, blending potential value with income. And our simulated investment in JD.com, it also yielded a healthy return, didn't it?
It did indeed. Not as spectacular as Alibaba, but solid. Our hypothetical $10,000 in JD 1 year ago at about $25.98 per share. That would now be worth approximately $12,960.03. So that represents an estimated pay profit of about $2,960.03, a 29.60% gain. Very respectable.
Okay, technically, what does JD's price action tell us? It's up from its lows, like you said, but it's still notably below its 52-week high and, crucially, that 200-day average. What does that signify for momentum?
Yeah, that's the key technical point for JD right now. The current price, $33.67, is about 30% below its 52-week high, but also nearly 29% up from its 52-week low. So a recovery, but maybe stalled. Both its SMA 20 at 5.50% and SMA 50 at 5.06% are positive, suggesting a positive short to medium-term trend is in place. However, that SMA 200 is negative, minus 5.74%. It's still trading below its long-term average, which is often seen as a point of caution, maybe resistance. The RSI at 59.46 is in a neutral to strong zone, not overbought yet, and its beta is low, 0.39, similar to Alibaba, implying less market volatility. So for buy-sell triggers, well, a strong long-term buy signal might emerge if JD decisively crosses and holds above that SMA 200. That would be significant. Short-term, maybe a buy could be considered on dips as long as the SMA 50 holds up. A sell trigger might be a break below that SMA 50 if you're managing a shorter-term position.
And what's making headlines for JD.com lately? What's the news flow?
JD's news really focuses on its operational strengths and strategic investments. Recent headlines include an earnings beat in Q2, driven by strong consumer spending, which is positive. They opened a new warehouse in Dubai, underscoring that logistics expansion internationally. There's also news about investments in food delivery and, significantly, an active bid to acquire the European retailer CECONOMY for about $2.6 billion. That's a big potential move. Analyst recommendations average a 1.42 buy with a target price around $43, suggesting, optimism about its strategic direction and its differentiated logistics-heavy model.
Wow, okay. What a deep dive into these 3 internet retail giants. Each really does have its own unique story, its own path. So let's pull back now and see how our entire hypothetical portfolio performed overall.
Right. So if we combine that initial $30,000 paper money investment, $10 in each, equally distributed 1 year ago, our portfolio would now be worth approximately $44,317.13, which represents a total estimated paper profit of around $14,317.13. That's a fantastic hypothetical return over just 1 year.
And breaking down the current allocation of that hypothetical portfolio, Alibaba, with its massive surge, now makes up the biggest slice, right?
Precisely. Alibaba, now worth $18,650 on paper, is the largest component at about 42% of the hypothetical portfolio. JD.com, with about $12,960, makes up roughly 29%. And Amazon, worth about $12,700, now constitutes around 29% as well, slightly less than JD. So yeah, Alibaba was clearly the star performer in our simulation over the last year with that 86.5% gain, significantly outshining Amazon's 27% and JD's nearly 30%.
That's fascinating. Alibaba's those numbers are phenomenal. Does this suggest maybe a broader shift in investor sentiment towards Chinese tech, or do you think it's really unique to Baba's aggressive AI strategy that you highlighted?
That's a really crucial question, and probably a bit of both. While Alibaba's AI investments are clearly a huge driver, that strong performance could also signal a broader, maybe cautious re-engagement with Chinese tech by some investors, especially given those lower valuations compared to U.S. counterparts we discussed. It really highlights the diverse opportunities within just this one sector, internet retail. Amazon represents that stable, innovation-driven behemoth, strong in AI and cloud, sort of a foundational stock for many. Alibaba is demonstrating a powerful rebound, fueled by those AI bets and maybe correcting from a previously undervalued position. And JD.com, while having that lower valuation and different dynamics, is making strategic moves, offers the highest dividend yield, pushing into new markets, offering a blend of potential value and income.
It's incredibly interesting how each company, even operating in the same broad sector, has such different financial profiles, technical setups, and, well, market narratives. It's almost like comparing, I don't know, a well-known established brand like Amazon to maybe an up-and-coming challenger like Alibaba that might have a bigger, faster growth ahead if it really hits its stride again.
Exactly. And those varying PE ratios and forward PEs really tell that story about market expectations and perceived risks. Amazon's higher multiples reflect its established dominance. Its consistency investors are essentially willing to pay more for each dollar of Amazon's earnings because they feel confident about its future. Alibaba and JD.com, being Chinese companies, might face different investor sentiment, different regulatory environments, different market conditions, and that's likely reflected in their lower PEs, even with those strong future growth projections. So critical thinking is essential here, considering both the impressive performance and the underlying market factors, the risks for each one.
What a journey through these internet retail titans. It's really clear that understanding these companies means looking way beyond just the headlines and digging into the granular data. Whether you're, building a hypothetical portfolio like we did or just trying to stay informed.
And this whole discussion really raises an important question for you, the listener, to maybe think about. Considering these rapid advancements in AI, we talked so much about the intense competitive landscape and just the evolving global economic environment. How might these huge factors continue to reshape the investment profiles, the market leadership within this dynamic internet retail space in the coming years?
Definitely something for you to mull over and perhaps explore on your own. We really hope this deep dive has armed you with some valuable nuggets of knowledge and helped you navigate this exciting sector with, hopefully, a bit greater insight. Until next time, keep exploring, keep questioning, and stay well informed.